Welcome back. Check futures right now indicating a mixed open this morning ahead of a much anticipated August jobs report. The state of the labor market could motivate the Federal Reserve to raise interest rates, but are markets ready to withstand some changes? Joining us right now is Charles Schwab, Chief Investment Strategist and Senior Vice President, Ann Sonders. Ann, great to see you.
Hi, Maria. Nice
Thanks
to be
so
here.
much for joining us.
Pleasure.
So let's assess where we are, if you will, ahead of the jobs number out on Friday. We got a GDP, which wasn't great.
Right.
How do you see things, economically speaking?
So I think the jobs report is extremely important, and certainly Stanley Fischer suggested the same thing. The one concern I have is that if it's a needle mover in the wrong direction, if it's particularly weak, if the Fed backs away from what has clearly been more hawkish rhetoric recently, not only from many members but from Yellen herself, I think it reinforces this notion that maybe the Fed is a little bit more data point dependent than it is data dependent. That, a single number could move the needle significantly in one direction. So I personally would like to see a nice strong number, reinforce the idea that the Fed feels comfortable moving maybe in September. I think that would be good for the market. I think the Fed continuing to sort of back away is not a good thing. I think we need that confidence message from the Fed.
Because even though this, not too hot, not too cold economy has been a positive for the markets, people want to feel that the Fed is not so relied upon and that they're not manufacturing things.
Right.
If we saw a good report, the Fed could start raising interest rates and maybe stabilize where rates should be, naturally.
And it has been the only game in town for the Fed because we haven't gotten anything on the fiscal policy front, and we're not likely to get anything at least in the next 6 months or so. So it has been the only game in the town. But I think I'm not a Fed critic by any means. I think what they did in the early stages of the financial crisis was absolutely the right thing. I think more questionable has been more recently staying as dovish as they have. I think it is time for the Fed to move to at least take that baby step toward monetary policy normalization. Again, the confidence message that sends, that the Fed is no longer treating the economic patient like it's still in the trauma room.
Yeah, so how does that relate to investing today? I know you're a long-term thinker, always have been, but when you look at markets, this year, what do we got? Technology and utilities, right. Really the strong areas. Do you want to stick with things like that?
So we have technology is one of the sectors on which we have an outperform rating. The other one is financials, actually. So we kind of stuck with the notion that the Fed would move, they would have the impetus to move, and that ultimately that would be to the benefit of financials, not to mention the value play that they were before you got this lift as a function of the Fed. No matter what the Fed does, if they are sort of stepping back onto this path toward normalization, they're going to do it in a very slow fashion. And I think that's important for markets, because if you look back in the long history of rate hike cycles, there are really two varieties. There's fast cycles and slow cycles. Fast cycles would be most of them that we have had until this one, where the Fed is moving pretty much at every meeting. Slow would be they pause every few meetings like they have been. If you look back at history, slow cycles have been much more rewarding to stocks than fast cycles, and I think we are definitely in a slow cycle.
Yeah, it seems that way because we sort of take 2 steps forward, 1 step back. The Fed looks at more than just the jobs report, right? It feels like the jobs number, though, is the only thing that we're seeing improvement
so we're
in every
seeing a modicum of improvement in wages, which in turn is the transmission into inflation. Core PCE, which is their preferred measure of inflation, is not at their target, but CPI actually is. And we're starting to see, great for workers, some building wage pressures. And I think they see that as a potential trigger for an increase in inflation, particularly if we continue to see strength in commodity prices. So I think when you look at their dual mandate, both of them are getting to the point of telling them they have that comfort zone to move.
What would you tell clients about 2017 at this point, or is it too soon to make that kind of call ahead of a presidential election?
Well, I think ahead of a presidential election, and given the lack of maneuvering on the fiscal front, it is still the case that we have to rely more on monetary policy. So we've got the uncertainty still as to whether it will be September, December, maybe both, maybe neither, and then the election uncertainty associated with that. So I do think it's going to be harder to look ahead into the following year for people in my position than it's been in years past. I think the bull market is ongoing. I think we're in a more mature phase where we'll see bouts of volatility, maybe less robust returns, but I think we are still in a secular bull market that has maybe a ways to go, and that's because I think recession is still far out. We don't have a strong economy, but recessions come when excess is built. And there's one benefit to this sluggish economy is we haven't built the excesses that tend to lead you into a recession.
Are there groups that you would gravitate gravitate toward if a Hillary Clinton presidency versus a Donald Trump presidency, or you don't want to play that game?
I think it's too soon to do that yet. There certainly are firms and analysts out there that are putting together, Clinton and Trump portfolios.
Right.
But I think that's in theory based on what the policy proposals are now. Most important, of course, is not just who's in the White House, but what the makeup of Congress is. Because we could talk about policy all we want. The ability to actually get it affected and put into law is a very different thing. So I think it's maybe an interesting game that traders play in terms of those portfolios. But in terms of actually making a definitive call for our investors into 2017, I think it's premature.
All right. Liz Ann, great to see you.
Maria.
Thank you so much. Liz Ann Sonders, Charles Schwab